Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst, and today we are going to learn about one of the most powerful yet underused valuation tools in our value investors' arsenal, the reverse DCF. Every investing textbook teaches the discounted cash flow model. You project future cash flows, pick a discount rate, estimate terminal growth, and arrive at an intrinsic value. The problem? Every single input is a guess. Change your growth assumption by just 2%, and the intrinsic value swings by 40%. Even Warren Buffett has said he has never seen a DCF model he trusted. But here's the genius twist: instead of building a forward model and guessing growth, you reverse engineer what the market is already assuming. This is the reverse DCF. It asks, given the current stock price, what growth rate is the market implicitly pricing in? Let me explain with a simple example. Say a company has free cash flow of 200 crore and is trading at an enterprise value of 4,900 crore. Using a 13% discount rate and 5% terminal growth over 10 years. You solve for the implied growth rate. The answer comes to roughly 22% per year for 10 years. Now you ask the critical question. Is 22% FCF growth realistic for this company? If the company has historically grown at 25% with strong sector tailwinds, then the stock might actually be undervalued. But if historical growth has been a lumpy 12 to 15%, then the market is too optimistic, and the stock is overvalued. This is the beauty of reverse DCF. You are not predicting the future. You are evaluating the market's prediction. And then you use your business judgment to decide if the market is right, too optimistic, or too pessimistic. The framework has 5 simple steps. Step 1. Gather current free cash flow, market cap, and net debt to calculate enterprise value. Step 2. Set your discount rate at 12 to 14% for Indian equities, and terminal growth at 5 to 6%. Step 3. Solve for the implied growth rate by trial and error or using Excel goal seek. Step 4. Sanity check the implied growth against historical performance and industry conditions. Step 5. Make your decision. If implied growth exceeds your realistic estimate, the stock is overvalued. If it's below, you may have found an opportunity. Now let's connect this to a real company. Consider Titan Biotech, BSE code 524717. Currently trading at 503 rupees with a market cap of approximately 2080 crore. The P/E ratio of 76 might scare traditional value investors. But the reverse DCF asks the right question. What growth is priced in at 503 rupees? When a company has doubled its operating margins from 10 to 19% and operates in a high-growth biotechnology input space, the implied growth rate may well be achievable. Here's why reverse DCF is especially powerful for Indian markets. First, it eliminates anchoring bias. You start from market price, not your own assumptions. Second, it works brilliantly in small-cap India where earnings are volatile. Third, it gives you conviction for concentrated portfolios. As Warren Buffett said, wide diversification is only required when investors do not understand what they are doing. When reverse DCF confirms your thesis, you can concentrate capital with confidence. Remember what SEBI's own study found. 9 out of 10 individual traders in the futures and options segment incurred net losses. F&O trading is gambling. Focus on quality stock picking using tools like the reverse DCF. Your action items: pick your top 3 holdings and calculate EV over FCF. Use the mental shortcut. Implied growth roughly equals EV over FCF minus 10. times 1.5%. Ask yourself if that growth rate is realistic. For a complete value investing education, check out our free course on YouTube. The link is in the description. And join our Telegram channel at Long Term Equity Y for daily insights. This is Manish Goel from Multibagger Shares, a SEBI registered investment advisor. Registration number INA 100007736. Remember, invest in quality, think long term, and never gamble in F&O. Thank you for watching.